And I'm recording out.
This is the first time I've recorded, so hopefully this works out. Okay, everybody, thank you for coming. Today we have with us Frank Xu, who is the founder and managing principal of Infinite Global Capital, and he's going to share with you today his 14 plus years of experience managing wealth and talk a little bit about a company you may have heard of called GameStop. So without further ado, Frank, thanks again for coming on such short notice. I really appreciate you sharing your time with us, and we look forward to what you have to tell us.
Okay, hey, thank you, Craig. Hey, everybody, my name is Franklin Xu. Been in the industry for about 14 years, also a certified financial planner. My day-to-day job is really to help clients grow and protect their wealth. So today, I really want to share with you about how to protect your wealth, because I think with what's going on since March of 2020, it's been an interesting ride. And I think there's a lot of new players coming in. And I know right now making money is really easy for some of you, or maybe for all of you. But Craig and I, we chat a little bit prior to the presentation, and we both remembered the 90s, where it's similar to right now, right? You can close your eyes, you can buy something, it doubles and triples within weeks. So it seems very easy, but we all know what happened in 2001. So right now, I want to share with you something that I wish I had back in the 90s when I was trading as a kid. So let me go ahead and share my screen. All right, so party like it's 1999. One big thing I want to share right off the bat is, I think right now information's abundant. You can go online, you can find all kinds of information about any stocks you want. And the recent hot topic is GME, of course. But a lot of times I find that people get bombarded with a lot of information and they don't know what to do with it. They don't know which one's important, which one's not. And it turns into a analysis paralysis. So one major thing, if you're trading for yourself, if you're managing money for yourself, if you're in the stock market, remember always to trade what you see and not what you think. And I'll dive in a little bit deeper on that. And I'll do a live demo on TradingView to show you how I use this technical analysis technique for me to help me trade what I see and to see the things that to me matters the most. Okay, so here's me. You can see COVID hair, totally different, right? Someone once told me hair is 80% personality. So, COVID made me another person. So that's my professional shot. And here's me at the post-COVID. And let me share a little bit about my tenure at Fidelity first. I realized that at Fidelity, I got the traditional financial institutional training, but it's really different when you apply it in a real life trading situation. And what do I mean by that? When you go to big financial firms, they always talk about diversification, right? They always talk about making sure you have exposure in all these sectors. And they always tell you the time you stay in the market is more important than timing the market. I used to believe in that until 2008 happened. When 2008 happened, I saw people getting wiped out. I saw my personal 401k, which was managed by Fidelity at the time, getting cut almost in half. And it took all the way till 2012 for my 401k to break even. And then my personal trading account, because I got out of it early, it only took me about a year and a half to get back to the previous high and then higher. So then it really puzzled me, right? How come something that's being preached by the mainstream media didn't work for me, right? And if it's being preached in mainstream media saying that this is the way it should work for everybody. And if it doesn't work for me, if it doesn't work for some of the clients I see, then what is the truth? So I started diving deeper into the wealth management aspect. Then I realized there are many things that aren't being discussed on mainstream media, and I would like to share it with you today. Number one is the financial planning aspect. A lot of times people focus on investment management, which stocks to buy, which stocks to sell, but that's only a portion of the overall financial planning scope. Within financial planning, you also have to think about other things such as litigation risk. You have to think about business risk. You have to think about inflation risk. You also have to think about your own family dynamic risk. For example, if you have kids, there's a risk of what happens if something happens to you and your kids are so small. How are you going to protect their future when you maybe possibly don't have enough saved up, right? And you have mortgage. So those are all financial planning risks that I think a lot of people, including major Wall Street firms, neglected back in the days. And another thing I think is very important is that financial firms, and I'm sorry to say this, but most mainstream financial firms are created to service the high net worth. So their business model, their financial planning model, and their investment models are all geared towards wealth preservation. And what I mean by that is if you diversify and put your eggs in different baskets, unless an '08 happens, most likely the wealth will grow steadily and hopefully keeping up with inflation. However, what happens if you don't have that wealth? Or what happens if the pot of money that you have is not that big? Well, then here's the issue. And this is the issue that I've seen happen over and over again, which is when you have a diversified portfolio, it grows, but then it grows really slow. So for someone in this current environment that might be underemployed or non-employed or getting underpaid, it's going to take them a very long time, maybe never, to save up the money that they need for retirement. So then they have to take risks. And that's what happened recently, which is a lot of people, they realize that with a traditional asset allocation, it's not going to get them where they want anytime soon. So they started taking risk in the market and it paid off. So from my personal experience, I realized that in everyone's life, depending on what family you're born into or your personal financial situation, usually you go through 3 phases. Phase 1 is starting asset accumulation. So maybe starting small, right? Maybe you save $1,000, save $2,000, save 10 grand, 20 grand. But at this stage, if you do the asset allocation, that money will grow really slow. So at this point, I would say if you're in stage 1 and you want to speculate, meaning that you want to see if you can make outstanding return with the money you have, you want to try to double your money within 2 years, 3 years, I would say go for it. But remember to manage your risk. Okay, so after a while, stage 1 will transition to stage 2, which is you have more assets and you have maybe more financial liabilities like mortgages, car payments. So you can't take the kind of risk that you're used to taking in stage 1. So then at this point, you can split your portfolio into 2. One is still more of the aggressive, high return kind of portfolio. But then the other part that you can't lose, that part should go into a traditional asset allocation diversified portfolio. Then as you transition from stage 2 to stage 3, you're entering into the high net worth group. Then at this point, most likely 99% of the portfolio is in the diversified realm strategy, right? And then you can still take a little bit to speculate. As you saw what Champath, the billionaire investor, did with a GME call, right? $100,000 might seem a lot to a lot of us, but then to him, it's only less than 1%. So those are 3 stages you want to keep in mind when you're investing. And that ties into the overall picture of financial planning. Okay, so today I want to spread this message that I think is very important, which is how to protect yourself in the next crash. I don't know how many of you invested prior to March of 2020, or how many of you invested through 2008 or even 1999, 2000 dot-com bubble. But for those who did, I'm sure you probably seen or remember or heard stories of people losing everything. Being in this industry for 15 years, I've certainly seen a lot. To share a story with you guys, I've seen this one guy. He bought a stock back in 2007. After he bought it, the stock price went from $25 to $10. Came back a couple days later with a $1 million check, handed to me and say, Frank, I'm gonna deposit it. I'm gonna buy more of that stock. I said, hey, look like this stock is dropping a lot. Maybe you should wait. He said, no, don't worry. I'm gonna average down. So put $1 million into that stock. A couple days later, the stock price went from $10 to about $1-ish. He came back with $500,000. Say, hey, I want to put more into that stock. And I told him, hey, maybe you should wait until things get better. He said, no. I believe in this company. I use this company. And there's no way, they're so big, there's no way the government gonna let them go bankrupt. Then finally, the stock price went to pennies, and it got delisted from the NYSE, the New York Stock Exchange. Do you guys want to hear which company it is? It's Washington Mutual. So for any of you that heard that company, you'll know what I'm talking about. And for you who don't, well, maybe you're too young, but I'm sure at this cycle of the market, you'll see stories like that. Okay, so what happened to this person and many other investors back in 08 is that they didn't grasp the important trading concepts, right? And they also didn't trade what they see. They traded or they invested in what they think, right? This guy, everything he said to me was, I think this company is still good. I don't think the government will let them go bankrupt. And I think it will turn back around. And it never did. But if he simply focused on trading what he saw or invest in what he saw, he probably would have cut loss a long time ago and preserved his $1.5 million and maybe had a chance to get back into the market when the market started turning around. So again, it's very important for you to keep in mind, always trade what you see, invest in what you see and not what you think. And I'll explain a little bit later on what you need to see. Okay, so the important trading investing concepts. I think these two are the most important thing to know right now. The first one is Rule 72, and the second one is stop loss and hedging strategies. And I'll dive in. I'll do a deep dive into these two rules and why it's important for you to have it engraved in your mind so that when the market starts to get volatile, when the market starts crashing, you know how to protect yourself. Okay, so let's go with Rule 72. So Rule 72 really is a way to calculate how fast you can double your money based on the kind of return you're getting with your investments. So here's an example. If you put your money into a bank and assume you're lucky, they pay you 1% interest rate. And right now it's 0.001%, but assuming you found a safe investment that's willing to pay you 1% annual return. Well, guess what? It takes 72 years to double your money. Well, someone say, well, you know what, Frank, that's terrible. I won't even be around in 72 years. How about I put the money into an S&P fund, like a Vanguard fund or like a Schwab S&P index fund? Well, historically, S&P returns 8%. So that means you take 72 divided by 8. It will take you 9 years to double your money. That's why you see a lot of people say, hey, you know, I can buy S&P index fund and do well. Yes, because if you bought an S&P fund around 2009, 2010, you more than double your money. Well, how about for those who want to really get ahead, right? For those who say, I don't want to be like my parents. I don't want to be like my grandparents where they have to work till 70 years old and retire and barely get by. I want to live the life that I dreamt of. I want to really realize, manifest my personal aspirations. And maybe I want to retire in 40, and retire as in I want to do something I am also passionate about, not just what I'm doing now. Okay, then you have to earn more with your return. So let's say you're able to earn 24% annual return year after year. Then see, it only takes you 3 years to double your money. So you can see that the more you make, the quicker it is for you to double your money. Sounds good, right? But there's also a flip side. What is the flip side? Compounding cuts both ways. So when you compound up, it's easy to double your money. But then if you suffer catastrophic losses in any of those years, it could really set you back. For example, right here, if you lose 10% of your investment, doesn't matter where, stocks, bonds, real estate, what you have left, the remaining 90% of your money needs to make 11.1112% just to break even. Well, what happens for someone who suffered a 30 to 40% loss back in 08 or even March? In March, S&P actually dropped about 30-ish%. Well, if you suffer a loss between 30 to 40%, well, you have to make between 43 to 67% of the money you have left just to get back to even. So you can see this really changes the way I see investments. And I hope this changes the way you see investments, which is what Warren Buffett often said. Rule number 1, don't lose money. Rule number 2, don't forget rule number 1. So the idea is every time you select an investment, instead of asking, hey, is this going to go to the moon, right? Is this going to give me 50, 60, 70% return? You have to think about, based on the price I buy this investment today, what is the likelihood of it going down 10%, 20%, 30%? Let's say if that, I mean, there's always a possibility that could happen. If that would have happened, what is my plan to protect myself? So if an investment dropped 30%, how do I avoid taking that entire 30% loss and limit the loss to, I don't know, 10%, 5%, right? And also, if I have a pool investments, I have a bucket of stocks, a portfolio of stocks I own, how do I make sure that I let the winners run, right? All my right picks are going to the moon, great. But then all the losers, I'm able to minimize the losses so that on average, I'm making my target return. For example, if I want to double my money in 3 years, then my target is 24% annual return. So how do I manage my risk? So this is risk management 101 using the idea of Rule 72. Minimize your losses and let your winners run. Okay. So to simplify things, I want to share with you this trading investment strategy or concept that I use. So before I dive in, let me explain what GMA is, what TA is. So GMA is what I call global macro analysis, and TA is what I call technical analysis. Of course, what's missing here is the fundamental analysis. I want to share with you a story of my own asset management journey. So I came from the old school Benjamin Graham, Warren Buffett value investing realm, and then in that world, fundamental analysis is everything, right? Global macro is also important because I need to know how the economy is developing, how different world economy, like how China's economy and US economy, how are they working with each other? How are they creating friction? And then how is that affecting the fundamental analysis of the companies I'm looking at? But in my younger days, I tried technical analysis and it didn't really work out for me because for me, it seems like technical analysis is a lot of hindsight. So I cut out technical analysis for a long time, focused really on the global macro analysis and the fundamental analysis. Then I started to realize that my performance wasn't consistent. And sometimes I get conflicting messages. For example, if you hear let's use an example, Apple. Let's just say if they report earnings and it's really good earnings, right? It beat expectations, but then the stock price starts going down. Then should you follow the fundamental analysis, which is, hey, it's doing well, I should put more money? Or should you trade what you see, the stock price going down? You're losing money there. And then if you add in global macro analysis, okay, Apple is expanding through the world. The market share is still growing. And worldwide, they're really receptive of Apple product more than other products. Then you see global macro analysis is green light, fundamental analysis, green light, but then stock price drop. Then what do? Right? So at this juncture is where a lot of people start flying blind. They start to guess, right? And then they hear a lot of people say, oh, don't worry, if it's a good company, just average down, average down, average down, right? But a lot of people don't realize that Apple can make a lot of money as a company, but if you bought a high and you see from the point you purchase stock to the point it is, if you suffer a 10% loss, 20, 30% loss, you as an investor dug yourself a hole. You have to get out that hole. So through my experience in managing money and trading, I came to this conclusion that has helped me generate pretty consistent results after I made this tweak, which is use global macro analysis and fundamental analysis to pick these sectors and the world, the part of the world that you want to invest in. Once you use global macro analysis and fundamental analysis to decide which areas you want to invest in, then you can use technical analysis to gauge the market sentiment. So for example, lately, if you take a look at the market, you'll see renewable energy. It's going up, it's going up. So a fundamental research person will say, hey, a lot of these renewable energy companies are now making money, right? So the global macro is a lot of countries are pivoting towards renewable energy. So global macro checks out, green light. But fundamental analysis, they're not making money. Here's a conflicting information, right? Well, not to worry. Now adding the third component, the technical analysis, and this technical analysis that I use is a bit different from what most investors use out there. Everyone has their own little technical analysis strategies, and I'm using mine. And my technical analysis will tell me, okay, even though GMA, global macro analysis, and FA, fundamental analysis, have conflicting information, but the TA, technical analysis, is confirming whether it's an uptrend. So that makes me more confident in investing in the position. So with that kind of intricacy relationship mentioned here, this is how I summarize my decision-making process. If the global macro analysis is weak, so if there's a lot, like right now, right? If there's a lot of issues in the economy, not just US, but also other countries, but the market's strong, then to me, that indicates that's a strong market momentum. So I will invest more. And sorry for a typo here. What if the global macro is strong, but the technical analysis is weak? So that's a perfect example of maybe around, I think, 2002, when the economy is recovering, but the market's weak. Well, that might mean market is overbought or there's not enough momentum yet. So at this point, if I have profits, I'll take it. If I don't have any profits or if I'm not in the market yet, I'll wait. So what happens if the global macro is strong and the technical analysis, the momentum of the market is also strong? Well, this to me indicates that or implies that it's a sustainable, strong market. There's a strong momentum behind it. So if I have something, I'll hold. If I want to buy more, I'll definitely buy more here as well. Then what happens if global macro is weak? The technical analysis also indicate there is a downward momentum, meaning that the stock price trend is going down. Well, to me, this indicates it's a bear market. So I'll hold cash. I'll probably sell all my positions. And of course, this is a general guideline, and this is not a financial advice. So you definitely have to look at your personal financial situation to make those decisions. But this is the general guideline that I go by. Okay, so for those of you that were in the market pre-March 2020, I'm sure you remember what happened back in March. And the reason why I want to show this chart is because I want to talk about the second important concept, which is stop loss or hedging. So if you look at what happened here, you can see from 2019 all the way up to 2020 in February, the market's an uptrend, right? And there's a lot of news about trade war going on, how certain part of US might go back into recession, government's printing too much money, and our economy's on life support. If the Fed pulls the printing press, the economy could crash. So a lot of negative GMA. But then to me, the TA is strong, as in you see this trend is going up. And I will stay invested here. However, around December, that's when I start hearing about the coronavirus. And the reason why I heard about coronavirus in 2020 is because I have some research team in Asia, and they're sending back this information. But I didn't sell my position immediately in 2020. I was waiting for a market to have a reaction, which I thought this was it. So when this reaction happened, that's when I put in some protection. But then the market resumed. So I waited until this happened here. And right when this happened here, and with my own little technical analysis, I can briefly say, when I see the black line crossing the red, when I see the stock price crossing the black line crossing through red and blue line, that to me means the trend has reversed. So now the TA is weak. So when the TA is weak, guess what? I started selling, taking profit on some of my positions, and I also started implementing what I called a hedging strategy. A lot of times you hear the term hedge fund, and now I think in the general media, they think hedge fund is this evil Darth Vader, right, kind of evil empire that try to take money from little people. But the origin of hedge fund really is funds that trying to look to use strategies to protect themselves in a market downturn. So the idea of a hedge fund is they can make money when the market is doing well, when the general market is doing well, and they can also make money or minimize losses when the market is really bad, right? So the idea of hedging comes from there. So here, that's when I started hedging. But you can see for people who didn't hedge, all the way from up here to down here, that's a solid 30-something% loss, right? And luckily, the Federal Reserve and our federal government stepped in and really bailed us out, so we're able to resume this uptrend. But what happens, here's a question you have to ask yourself. What happens if the crash comes again, but then the government's not able to pull it back? Then you'll be stuck down here instead of sitting pretty up here. So that's something that I want you to think of, is not, oh, okay, the market will always get pulled back up, but what happens if the market doesn't get pulled back up? What's your plan B, right? Okay, all right. So here's my plan B. Let me share it with you. So as the market started tanking, like the previous chart, I started putting in investments that will move inversely to the market. So as you see the market start crashing down here, my investments in here, the hedging vehicle that I use here are going up. And one of the hedging vehicle even went up 3 times my original investment. And because of these 2 investments that I added when I saw the market signal, I was able to preserve my clients' wealth a lot better than I hoped for. I'm really happy about that. And here's a result of what happened. You can see this is on March 16th, 2020. That was probably the worst day in the market in 2020. Dow Jones, that single day alone, was down 13%. S&P was down 12%. NASDAQ was down 12%. So on average, the market was down about 12.5%. And here's our client's portfolio. You can see that on average, they're down about 1.41%, right? And some even made a little bit of money on that day. So I want to show you this chart, not to say that I'm a genius, because I'm not, right? There's way more people that are way smarter than me in the market. But the way I manage my clients' risk is I always assume there's something I don't know out there. So I always create a plan. And the plan is always, if it does well for me, how am I going to take my profit? If it doesn't go well for me, how do I protect my losses? What happens if there's something I don't know? If the unknown happens, will I still be able to protect my wealth? So these are the core questions I ask myself every time I enter a new position, meaning every time I buy a new stock, every time I sell a stock, every time I'll switch to different investments, and every time I decide how much cash I want to put into the stock market versus how much cash I want to pull out of the market. And with this, I want to show you how I look at things in real life term. And let me go ahead and switch my screen share. Okay. Can everyone still see my screen okay? Give me a thumbs up. Perfect, thank you. All right, so this is an S&P 500 chart. And you can see that this was, let's see here. Okay. There we go. Okay, sorry, it's stuck a little bit. All right, there we go. Okay. So you can see this is March, what happened here, and this is what happened after. So my investment strategy, or let's say my technical analysis, the way I use it is that I believe the moving averages is the cost basis of what the investment public paid as a whole for any investment. And here, the black line is 20-day moving average. The red line is 60-day moving average, and the blue line is 120-day moving average. So I believe that as long as the moving averages is going upwards, the stock price will be pulled upwards. Unless the stock price can break and reverse the trend, then I wouldn't worry. So that's the idea of it. A lot of times you hear a lot of people teaching their technical analysis saying that, oh, there's this signal, that signal. I think all these signals all came from the basic fundamentals of price and volume. So if the price goes up and the volume goes up, then all these other technical analysis indicator will show similar messages. Or if it reverses, it will show something similar as well. So the idea is not to make your trading system complicated, but it's to simplify it as much as possible. And also, a lot of times people say, oh, okay, Frank, what does this mean? This movement mean? Well, I think the movement itself is not as important as the characteristic of the movement. So, for example, if the stock price is going up, is it going up quickly? Is it going up as it did in their previous uptrend, or is it a little bit different? Because you can get a lot of messages on the characteristics or the changes of the characteristics of the price movement. So here, for example, over here, you can see the black, red, blue line all trending upwards, right? And then the black line touched the red line, but didn't cross. So that to me indicates that, yeah, market could fluctuate a little bit, but then the overall technical analysis is still strong, right? So even if GMA, remember the summary, GMA weak, TA is strong. TA is strong right here. Not worried. I'm not going to scare myself with all these bad news or supposedly negative news in the financial media, exception mainstream financial media. But okay, right here, anyone who tells you they can sell up here, They're either lucky or they're lying. So over here, I didn't see anything, but boom, right here and doing right here. When these two drop happened, I see the line crossed. It turned and crossed. So this to me indicate that, okay, something serious is happening, or something happened to the effect that it scared majority of the investment public that they're pulling their money out. So I don't know if it's retail, I don't know if it's institution investors, I don't know if it's hedge funds, but a lot of money are being pulled out here. So I'm not fighting the market. I'm pulling my money out too. I'm putting in protections. So I put in my protection around here. So it dropped all the way down here. And a lot of times people will say, hey, Frank, looking back, this is the best place to buy. I will say, yes, I bought here. I bought Amazon, I bought Facebook around here. But was it because I was so good at the spotting the bottom, or was it because my technical analysis is so amazing? No, not at all. This is just the point where I figured, hey, I'm willing to start nibble a little bit on the position I want to buy, meaning that I think it's bad enough, but I think it could go lower. But this is a good point to start trying. So I tried here, and obviously I was lucky. Market reversed, came back here. But you can see that even here is not the place to buy. Really, for me, using my system, I will be more comfortable buying around here. Why? Because you can see that the moving average, the black line, has turned around, meaning that the negative momentum has reversed into a positive momentum. So this is when I will start buying. And then over here, I'll buy some more. And over here, you can see that all the momentum, the black line, the red line, the blue line, they're all lining up upwards again towards the 2 o'clock direction. So that to me indicates that, okay, the uptrend is confirmed. So there's no need for me to panic in any bad news anymore. And we all know that in June, they talked about double dip. They talked about going back into lockdown again. Same thing happened in September, October, all that happened. But see, the trend got pulled down a little bit, but it's still going up. And because of this reason, I will actually be a buyer in these spots instead of a seller. So you can see up here recently what happened is a couple days ago, market dropped, right? A lot of news outlets said that, oh, it's because all these hedge funds need to pay up for their GME shorts with the money they lost there. They have to sell other stocks to cover. So that might trigger a Lehman Brothers type crash. Well, until that happens, I'm not going to scare myself out of the current market. And you can see quickly bounce back, because as long as the trend is strong, it will take a lot for it to pull back. And now people ask, well, Frank, you can't tell the future. So how do you know when to get out? How do you know it's not a head fake? It's not a fake and go back up at something like here? Well, my answer to you is, I don't know. I don't know if it's a fake or not, but I know that every time when the trend starts reversing right here, when I see the stock price go below all the moving averages, and I start seeing the shorter time frame moving averages crossing the longer time frame, that to me is telling me, hey, something doesn't seem right. I should put in my protection. I should keep a close eye on my stocks that made profit. Maybe I should take profit soon. And I can put in my protection here. So if it doesn't happen, it goes right back. It's okay. I'll close out my protection. So the idea of hedging really is, think of it as a auto insurance, right? When you buy auto insurance, and let's say you get into a minor fender bender or minor scratches, you won't report it to the auto insurance because you don't want your premium being raised. However, auto insurance there to make sure that you're made whole if you get into any catastrophic car accidents. So that's the idea that you should approach hedging, is you're not trying to make money on the way down. You're trying to make sure you don't lose any money, or your portfolio fluctuation to the downside is very minimal through a auto insurance type protection. And that's different from shorting. For those who are thinking about shorting, yeah, this is definitely the place where you put hedge, is definitely a place that you can also short. And I know that can really tie into our next conversation on GME. So on this note, I'm going to conclude my formal presentation, and I'll open it up for the GME questions or any other questions.
So Esme, what do you think? Do you want to ask some of the questions that were submitted to you, or do you want to go off the 4 or 5 that we had ready yesterday first?
So let's go ahead and start off with the questions we had already prepared. That way we address what we discussed as a club first. But we do have a couple questions, so maybe 8 minutes towards 5 minutes
Okay.
I think would be good to address the rest.
Okay, so I've got those written down, so I'll go ahead and ask those. Let's see, let's start with the first one. So the first question they had was, does it sound reasonable that Robinhood needed to halt GameStop because of liquidity issues? So I think what they're asking here is the official story from Robinhood halting purchases of GameStop legitimate? And maybe even explain what that even means, why they had to halt because of liquidity issues.
Okay, great question. So we all saw the CEO of Robinhood came on to different news channels saying that they don't have any liquidity issues, but then later on they changed their story saying that they do, right? And the official story, well, we never know the truth, but from my point of view, I think the story is legitimate, and it's possibly a main reason why they almost went bankrupt, and that's most likely the reason why they needed additional help from their backers, which is Citadel. And the reason why is because pre-2008, before the previous financial crisis, banks and brokerage firms are free to have higher leverage. But then after the crash, I think our government realized that there is a huge systematic risk if they allow banks to have such high leverage, or allow brokerage firms to have such high leverages. So they raised the capital requirement, meaning that if Robinhood is allowing people, or not just Robinhood, TD Ameritrade, Schwab, E-Trade, if they allow their customers to buy X amount of shares, they have to reserve, let's say, a couple percentages of capital to that trading volume. So I'm just throwing out a random number. This is not an accurate number, but I'm saying, for example, if Robinhood's customers bought $1 billion worth of stocks, then maybe Robinhood's required to have 30% of that $1 billion in capital. Then what happens if the stock price went up, and then these Robinhooders or these customers took margin and bought even more, bought $3 billion more shares? Well, now Robinhood has to come up with more money to cover the capital requirement of the additional shares that their customers bought, right? So what happened is that when Robinhood doesn't have that money, then there is what we call a counterparty credit risk, meaning that when the trade is settled, T+2, trading day plus 2 more days, if the market goes up and down and Robinhood customers don't have the money, then Robinhood have to cover the differences with it to settle with the other side of the trade, to settle with other brokers. So that's, at least from our point of view right now, from my point of view right now, the main reason why Robinhood had to slow down their customers from buying all these very volatile stocks, because Robinhood, the company, is on the hook between the buy date, between the trade date and the settlement date.
So kind of similar to how banks have to have certain reserves.
Mm-hmm. Exactly.
Okay. So the next 2 questions are related. How do naked shorts work, and why do naked shorts exist?
Okay, so naked shorts, before we talk about naked shorts, we have to talk about the mechanic of short selling. So short selling is the opposite of buying stock. So when you buy stock, you make money by buying low, selling high. When you short sell, you're selling high and then buyback low. So in order for you to short sell, pre-2008, you could do naked short selling. So you could sell stocks, you can borrow stocks from your brokerage firm and sell it. And if your brokerage firm doesn't have those stocks, it's okay. And after you sell it, if it drops to a certain level, you want to cover your short, you can buy it back. So that created an issue, which is the short selling to float, meaning the percentage of shorting, stocks being short is over the actual stocks trading in the market. And that caused a systemic risk to our financial system in 2008. So after that, Dodd-Frank bill came out and said, okay, nobody can short sell. The only person that can still nobody can naked short sell, but the only group that can still do naked short is the market maker. And the market maker is the group or the important party that helps create liquidity and maintain liquidity. So imagine right now you want to sell a stock. You see a stock price and it says 100 on your screen. You go and you click sell, and then you get your transaction statement back. It says online, it says, oh, you sold your stock for $50. Say, whoa, wait a minute. I saw 100. I'm trying to sell it for 100. How come you're telling me that I sold for 50? Well, this could happen if there's no market maker creating liquidity. The price will be very choppy. So in order to make market makers' job easier, they are allowed to short sell stocks. So if you buy, they have to short sell. So they short sell stocks to make the market, to create that liquidity so the price won't be choppy. But they are also required to be in possession of the stock within the period. So that's why naked short selling is banned, but then it's still allowed for the market maker.
I'm not sure I like that story. But if that's the answer, that's the answer. So the students also wanted to know why, from your perspective, is GME currently tanking and has been tanking over the last couple of days?
Okay. You have to look at this situation from many angles. I can tell you my personal angle. I was looking at GME around $17. So since everyone can see my screen, I can pull out the chart. We can talk about it based on the chart, right? Okay. So let's see. Okay. 20.
So did you buy into this at all?
I didn't. Yep. And then everyone can hear. So this is the fun part about investing, because I like to say that there's no professionals in our industry. There's only winners and losers. And and the market's fair. You get proven right or wrong with your returns, right? So let me tell you my point of view, and then you can take it with a grain of salt. So I looked into GameStop, and the reason why I looked into GameStop is because I found out that Michael Burry, one of the most famous characters, real life person from The Big Short, owns it. So and then my friends are big in gaming, and they keep telling me that gaming is a place to invest. So I bought gaming ETFs, gaming ETFs, industry ETFs. So it was going pretty slow. So I started looking to GameStop, and then after doing research, and this is research I've done for it. I look at the business model. I came up with the conclusion that the business model is a dead business model. I also gave my thought, which is I think GameStop has to pivot into a Netflix type of entity to start making money. But then the problem is they don't create their own content, and the distribution channel is already being blocked off to them. I mean, I'm talking about the online distribution channel. So the fundamental analysis wasn't good. What about the GME, the global macro? Well, I think global macro is good, right? People want to play games, but because COVID, I don't think a lot of people will go into the store to buy games. So global macro is good for gaming, but not necessarily good for GameStop. And then I started looking at the technical analysis point of view. And technical analysis is like, okay, they're going sideways for a while. The short interest is pretty high. So there's a possibility that they could get squeezed if a good news comes out. So this goes back to the mechanic of short squeeze, and I'll talk about it in detail a little bit later. So I was thinking, okay, if they're able to get to the technical analysis point of view that I want, then I will go in. And it just never did. So then when it got short squeezed to 36, I thought it was too late because I didn't believe in the fundamental of the company. And then it subsequently went up to $300. And a lot of people might say, okay, Frank, you're pretty lousy for missing that. And my response is, that's a possibility, right? Maybe I didn't see something that the famous Redditor Deep Effing Valley saw. However, I traded my plan. So even when I missed out on this gain, all I can say is, okay, right? It's like me folding. It's almost like the scene where on Casino Royale where I have really bad cards, but then it turned out to be a royal flush, but then I folded it, right? And that's the way I see it. It's like, well, at least I preserve my capital. I'm alive to play another day. So that's my point of view of how I approach GameStop.
Yeah, I think it was Jim Cramer that said one of my favorite quotes in the markets, which is not profiting as much as you could have is the best kind of problem to have.
That's a good quote, but I think someone who will appreciate that quote has to lose money in the market first.
Well, then I satisfy that condition to appreciate it. Okay, the last pre-written question before today. There was questions on how we can see how much of a company's stock is being shorted. And I think we answered that in our last meeting. As long as you have TD Ameritrade, or I think at least on Yahoo Finance, it even shows you. But is there a place we can get more detailed information, like how much is being purchased?
I would say TD Ameritrade is probably one of the best places to go. Yahoo Finance, you can see who are the majority holders and sellers. But you can also go on to sec.gov to track them. But I think right now, all these trading firms have made the platform so easily to use. You don't have to do your own research that way. You don't have to go on to sec.gov, create a spreadsheet to track all of it. I think a lot of websites out there will track it for you.
Okay, I think that's the conclusion we came to. I just wanted to see if you had any other sources, so that's good. All right, with that, I'll turn over to Esme to ask the viewers' questions.
All right, and the viewers' questions are still being collected for as long as we still have our guest speaker present. But let's start off with a question from Victor, who asks, if you are familiar with the Boggle method of investing, particularly with maybe holding on to some stocks long-term and seeing how that goes.
Yep, I am very familiar with the Boggle investment strategy. I respect them very much. However, my opinion on that is slightly different, and it comes from doing a lot of financial plans for clients. I'll give you an example. If you are in your 20s or 30s or even 40s, you can withstand some market hits. So, for example, if you go in and buy a Vanguard S&P 500 fund, right? So let's say we pull it all the way back here. It's even easier, right? So you can see this. From 2011, if you bought it here, you held it here, you pretty much about 3 times your money. Great. But what happens if you plan to retire right here? You're not in your 30s, but you are in your 50s. So you invest in this, it did well, and then you're about to retire and then market crash. and now your retirement fund just shrank by 30%, right? So what I'm saying is, I think long-term holding is important, especially holding on to the investments when the trend is in your favor. However, you also have to take in your personal financial situation into consideration, as in, if you have time, hold. But then if you're near retirement, you have to consider what we call a asset transition, meaning you're transitioning your assets from growth assets to income, passive income generating assets.
Got it. Okay. And for those of us that aren't too familiar with the Boggle method, is there a brief synopsis you might be able to offer?
Okay, I'm gonna definitely butcher it, but this is my understanding of it, which is you don't have to do any fancy investments. You don't have to spend all your time buying stocks because the market's already efficient itself. All you have to do is close your eyes, buy index funds, and let the market do its work for you. Let the market and time make money for you.
All right. Thank you. The next question comes from Mario, who asks a little bit more about your objective opinion. Do you think that the S&P 500 is in a financial bubble?
I think the whole world is in a bubble. That's my point of view. And there's definitely a lot of pundits out there, and a lot of pundits I respect tremendously, saying that, okay, the fiat currency is pretty much worthless, the entire financial system will crash, etc. That might be true. It looks like we're heading that way, right, with the unlimited QE from our government. However, we're standing at point A. That's point Z. Between point A and point Z, you got B to Y. There's still a lot of money to be made between B and Y. And you have to keep in mind, the time where you can make the most money is during a bubble. When there's no bubble, there's no price action. Everything's flat. You won't make any money there. So yes, I think we're in a bubble, but I also think right now is a really, really great opportunity to make, I think, in my opinion, life-changing type of investment return. But keep in mind, when there's a bubble, there's also the risk of bubble bursting. So that's why protecting yourself, having the stop loss, having hedging strategies, having a trade plan, knowing when to get out is very, very important.
I would like to ask a follow-up question to that then, because this is the same thing I've been hearing, that bubbles are everywhere in all assets. In addition, we could have, if velocity comes back up, we could have hyperinflation given the money printing going on. So you don't want to hold cash. So then what on earth do you do with any value that you're generating right now? So a person gets $1 more. Where should they put it? And why is it precious metals?
Well, the idea of precious metals that there's I guess there's a scarcity in the supply. So we can't keep maximize the production of, for example, gold or silver, right? So there's also the traditional thought that we as in the entire world came from a gold standard, so we can revert back to a fractional gold standard. But I think that it's important to diversify, and this ties into the overall financial planning aspect, which is you want to diversify because you don't want one black swan event to wipe your entire wealth out. So you have to diversify into precious metals, but you can also think about diversifying into different currencies. If you think about it, one of the biggest risks that we're facing about talking about velocity M2 is that, if M2 starts picking up, then we have so much fiat currency, US dollar, let's say US dollar, floating in the market. Now it's exchanging hands a lot quicker. So that's where the hyperinflation is. Well, if you think about investing in gold or anything else, you have to think about, is it still pegged to the dollar? So when you think about diversification, if you diversify into a bunch of investments, but they're all still pegged to US dollar, then if something happens to the US dollar, then you could still take a huge hit with all your investments. So your diversification might not be as diversified as you think.
Yeah, and that happened during the last crash. Gold also went down, which you would think, well, that's why I hold it, so that doesn't happen. But you're right, it does, because when it's tied to the market, this is my opinion. If I'm wrong, let me know. When you've got GLD or paper gold, right, and other gold assets in the market, when people got to liquidate, they liquidate everything, right?
Exactly. So that's why, in my opinion, and this is my personal opinion, I think hedging is the way to go, because I diversified into gold, right? So in March 2020, when markets started dropping, gold was holding up great, and my hedges are making a lot of money. But then towards the end of the crash of March 2020, gold started dropping a lot as well. But my saving grace was I was shorting the market. I was shorting S&P 500. So hedging is investing in something that moved inversely to the market. So something that can match 1-to-1 with S&P 500 movement is shorting the S&P 500. So I was shorting the S&P 500 plus using VIX to try to generate return as the market is going down. So yes, I will say a proper diversification is something that's not pegged to the currency that ties your majority assets to, and also invest in something that has hopefully zero correlation or 100% or close to 100% negative correlation in those times.
All right, back to you, Esme.
All right, so this is more of a general question. For someone that's looking to go and venture more into the financial sector, what courses or word certifications might be handy to have in your tool belt for, the next coming crash?
Okay. Depending if you're getting a job or you're trying to make money through investments. If you're trying to get a job, let's say you're trying to get into financial planning, then definitely Series 7, FINRA Series 7 license, FINRA Series 66 licenses are both good to have. If you can get a CFP, Certified Financial Planner certification, that's great as well. If you're looking to become an analyst and hopefully become a portfolio manager in the future, then I would say you can get started with CFA, Certified Financial Analyst Level 1. Those are also good to have. If you're trying to make money trading, then what I will recommend is to understand the CFA material, but then at the same time, open up a trading account. For example, TD Ameritrade Thinkorswim platform, it allows you to paper trade. So what you can do is you can paper trade, meaning you can place simulated trades. So those are not real money. So you can test out your strategies with the paper trading platform. And if you can come up with a consistent money-making investment strategy, I'm talking about overall money-making strategy, because I don't think anyone can make money on all of your trades, but as long as you're positive, then that's great. So when you can generate a consistent profitable strategy, then that's the part that will help you there.
Got it. Okay, and we do have another question. If the stock market looks like a bubble, does that affect the U.S. property market?
I think this should be taken from a different point of view. And the point of view I like to use is the global macro analysis point of view. So right now, you see bubbles everywhere. And in my opinion, I think the main reason why is because we have infinity QE plus pretty much near zero Fed funds rate. And this creates a very interesting dynamic in our society. And we see a bubble up everywhere. And this is what Howard Marks talked about, the second level of thinking. We all read the same news, or most of us do. But it's important for us to have a critical mind. We have to be able to dig deeper, connect the dots under the surface. So the way I see it is, and this has been talked about in CNN, CNBC, all these other channels, but what I see is that a lot of safe money or risk averse investors are being forced to invest in riskier assets. And they went from AAA bonds or Treasury to AAA bonds to maybe junk bonds mixed with dividend paying stocks to now growth stocks, and then now finally to real estate, right? Being a landlord or REITs, etc. So to see when the bubble will pop, focus on what the three big things I'll focus on. Number one is the Federal Reserve policy, also the other central banker policies. That's number one. If they even talk about tapering, I will start being really cautious. I'll probably put on my hedge if they even talk about tapering. Number two is I'll look at the US 10-year Treasury. That's where you can kind of gauge if inflation is creeping up. Right now, it's roughly about 1 to 1.1-ish percent for the 10-year US Treasury. If it starts going up fast, then that's another concern. I will definitely put on a hedge. Number three is the US dollars. Everything's tied to the US dollars, at least majority of assets in the world, especially within US. So if US dollar starts to get strong, that's also a negative effect to the bubble as well. And that's where I will also be cautious.
Okay, thank you. I think that just about summarizes the questions open from students. Dr. Kerr, if you want to take over.
Okay, great. I want to be mindful of your time, Franklin. Thank you so much for coming out, but I'm going to sneak in one more question if you don't mind.
No problem.
Okay.
No problem.
So I'm going to quote Jim Cramer again, because I really like him. I think he's great at educating people and getting them into the market and getting them interested. He always advises people who are starting out, put their first $10,000 into S&P index like SPY. Do you think that advice is still good today? And before students or beginning investors go and do that, how would you rate where we are now in terms of your global macro technical analysis?
Okay, great questions. I would say the way I see S&P 500 is a benchmark. So if you can beat S&P 500, then you should definitely invest in with your strategy. If you tested out your strategy and you cannot beat S&P 500, then it's good to own S&P 500. Or you can take a hybrid approach. You could split your portfolio into two pieces, what I call the alpha and the beta. So the beta is what we use, one of the ways we use to measure risk. So S&P 500 has a beta of 1. So the portion that you have in S&P 500 fund could be the part that keeps up with the market no matter what happens, right? Because it's an S&P 500 fund. And then the alpha could be the ones where you think you have a chance to outperform the beta, outperform S&P. And then depending on your experience and your confidence, you could shift the allocation between the beta and the alpha. So that's the approach I would take. Mm-hmm. And sorry, what's the second question again?
So if they're going to follow that approach, and maybe if they don't have a strategy yet, they might just buy all S&P index, which is fine from what I gathered you said. But should they do it today? That was kind of the second part. Where would you rank where we are today in terms of your global macro analysis and technical analysis? Which category are we in?
Okay. Global macro analysis, I would say I think the economy is being propped up by a lot of our policies, right? And I think that there is a chance for our economy to recover and grow stronger. And I think that really hinders on our government's attitude towards vaccination and also when to unlock the economy completely, right? But like I said earlier, that's how I decide where to invest in. But when to invest and when to get in and get out, that's where I would rely on technical analysis. And since everyone can still see my charts, I'll just use SP as an example here. So I guess a very dry cut way to explain my strategy is that I won't buy this is how I do it. So everyone's a little bit different. I know a lot of people, they set up where they buy and forget it. So every month, doesn't matter what happens in the beginning of the month, they'll put X amount of money into an S&P fund or into a NASDAQ fund. That's one way to do it, especially if you have a lot of time, your time horizon is long, you're still pretty far from your ideal retirement age. That's a way to go about it, right? But if you want to be a little bit more active in the market, and you think you can beat the market, because another way to beat the S&P is to get in and out at the right time, right? And this is what I would do. I won't buy it here. I will buy it when it pulls back. And then now the question is, how do I know this pullback is the bottom, right? Because hindsight's always 2020. Well, this is a technique that I use, and I'll share this technique with you because this is not something that will lose its effect if more people know about it. Matter of fact, if more people know about it, it will strengthen its effect. So I focus on the cycle of the market. Market or individual stocks are like people, right? They have a cycle. So all you have to try to determine is, are they in the infancy stage of the cycle or adult strong, or are they in the like 80, 90-year-old, like the end of the tunnel kind of, or end of the light kind of cycle, right? So what I will do here is, the easiest way to look at this is you take today's price right here, and then you count back 20 days. So again, I base my investment decision, like when to get in and out, on the moving averages. So if the moving average trend line is still up, then I'm more comfortable buying here. You can see right here that the trend line is still up. So what I will do is this. And to determine where the trend line will go, this is going to get kind of technical, but if you have any questions, feel free to ask me offline. So I look at the stock price, for example, in this case, S&P from 20 days ago. If the stock price from 20 days ago is going down, and what I mean by that is every day it goes forward, it'll go up or down, right? So for example, right here, how do I think this is a confirmed trend? Very easy, because if you look at here and you count back 20 candlesticks, 20 days, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. So you can see from the stock price from here to here, the price of the previous 20 days keep moving down as the price go up. That creates a momentum. So that momentum will drive the moving average upwards. So by me seeing that, okay, most likely the price from X amount of days ago, in this case 20 days ago, will be heading downwards as each day go forward. See, if one day goes forward, then one day goes forward. So I can see the price from 20 days ago, what I call the anchor price. I call it the anchor price. When an anchor price starts going down as the stock price go up, that means it will pull the moving average line up. That means there's more momentum. So that means I can be comfortable buying around here. However, if it's a reverse, for example, if you look at the price from here, 20 days ago is roughly here. So you can see as we inch forward, the stock price is going down and the anchor price is going up. So that creates a reverse momentum pulling the moving average down. So that to me is an indicator that the momentum slowing, possibly reversing. That's when I will not buy more. I know this sounds pretty technical and there's a lot more detail in it, but this is kind of how I use my technical analysis to, I can't say predict the future, but to draw up different scenarios, right? A bull scenario, a bear scenario, and what I will do if it's a bull scenario, what will I do if it's a bear scenario.
That's great. That's a lot of really good information. Thank you so much for sharing your strategies
No
with
problem.
us. So before we get out of here then, if any of these people become wealthy and have so much money they don't know what to do with, which they all will, graduating from Cal Poly's econ program, how would they get in touch with you if they want to have you help manage their money?
Great question. So here's my contact information. You can reach me at my business cell, 626-616-8195, or my email at fhsu@igcinvestment.com. And as you see in the background, that's me as a baby, and that's my mom.
All right. Well, thanks once again for taking the time out of your day, especially on such short notice, to talk with us.
It's an honor. Thank you.